Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And in this webcast series, we can get a little bit sophisticated, adding more and more technical indicators to a chart. But is there ever a time where a trader might choose to use just one indicator to plan and place a stock trade, start to finish? The answer to that question is yes. And today, we're going to be doing exactly that, using a technical indicator that might be familiar to some of you if you've been following this webcast series for a while. We're going to be talking about the TTM squeeze and how it might be used to plan and place a stock trade, identifying entries and exits. We're going to be talking about the pros and the cons, the construction of the indicator, a lot to cover. But before we can get to any of that, let me first of all say hello to everybody out there in YouTube. Great to see so many familiar names, and I'm seeing some unfamiliar first-timers here. Welcome to you. But hello there, Janelle and Danny, Joe. Give me that. Ted, James, Sharon, Frank, Lori, Tony, Chris B, Ray, and everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you are among those that are here for the first time, I want to welcome you as well. I hope you enjoy the show. I hope you put it in your calendar to join us on a regular basis, or just watch the archives if that suits your schedule better. But if you are watching the archive sessions and you'd like to join the live stream, well, you're certainly invited to join us. This is a Friday webcast series. We kick things off promptly at 1 Eastern time. We'd love to have you here in the live stream audience. And as a special treat for my live stream audience members, I have my very good friend, Ben Watson, hanging out in the chats. Ben's going to be addressing any questions that I can't get to. Ben and I have now been working together for more than 20 years. So Ben is fabulous, great resource to have. Thanks for having my back there, Ben. And Ben and I would like to issue an invitation to everybody listening. If you have an account with X, you should be following your favorite presenters there. It's the best place to connect with your favorite presenters in between these live streams. You can find Ben on X at Ben Watson CS. You can find me there. My handle is at Cameron May CS. But let's get into this discussion of the TTM squeeze. And as I do, chat in, let me know, is this a technical indicator that's familiar to you? Would you consider it to already be part of your toolbox? Or is it going to be brand new to you? I'm going to go at a pace that everybody can follow. But I'd like to get that sort of an input. But as we, with that set as the background, let's talk about risk. Of course, risk is real. Bear these important disclosures in mind. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Any investment decision you make in your self-directed account is solely your responsibility. Investing involves risks, including the loss of principal, and Schwab does not recommend the use of technical analysis as a sole means of investment research. All right, so with that important stuff accomplished, let's set the agenda for what we're going to be doing with our time together today. First thing that we're going to be doing is revisiting our current positions in our example paper money portfolio. So we're going to look at the logic of those trades. We're going to see what's changed on the charts of those trades. We're even going to be closing one of those up. Then we're going to take a look at what's going on with the markets from a specific technical perspective. We're going to be looking at the S&P 500 through our trend, value, and momentum set of indicators. So we'll see what's going on there. Then we're going to plan and place a new trade using an indicator known as the TTM squeeze. Obviously, as we dive into that, I have to make sure that everybody knows just what it is before we can talk about how it works. And then we'll illustrate how that might be used to identify entry and exit signals using example charts. So that's it. Okay. Chris B. I've got to give you credit. I don't mind giving a spoiler here. Chris says BAC is breaking out of a TTM squeeze today. Guess what today's trade's going to be? Yep, nailed it. Anyway, Art says, the TTM squeeze, you don't use it to trade? Yeah, sometimes we have a tool in our toolbox that it's not the one that's going to help us build what we're trying to build, right? This webcast series is never intended to be a promotion of a specific tool or approach to the markets. But let's go right to the Thinkorswim trading software desktop platform, and we're going to have a look at our two positions here. We have some Amgen, we have some AT&T. Amgen, I think we need to do something with it. So let's go to the charts. Here's our Amgen. Actually, this was a shorter term trading approach that was demonstrated. and things can change rapidly in short time frames, and they have. So let's come up here. This one used a different time frame as well as a pair of technical indicators. So I saved that as a style, a chart style. So we're going to go up to our styles. We're going to load up the style for our Amgen 20 triangular moving average and 5 exponential moving average system. So let's select that. Now, a typical, just to revisit the logic of this trade, if you weren't here and watching this one live as I described these indicators and how they might be used in conjunction with one another to plan trades. Basically, we're using a faster moving average overlaid over the top of a slower moving average, generating crossover signals. And that might lead a trader to signals that might be when to buy and when to sell. For example, Friday, a couple of weeks ago, this is actually now a few weeks back, there was a crossover right here as our 5 exponential crossed over our 20 triangular. And then we might have looked for an exit as that crossed back down and through. Now, crossover systems can get choppy and deliver what we'd call whipsaw signals if stocks go sideways over any time frame. This one's a faster time frame, an hourly chart. But yeah, it can get buy and sell signals that can lead to small gains and small losses and kind of frustrating and annoying. But their intention is to get us on the right, so the correct side of a larger move. Now look at where we are right now. Ooh, this is actually, I was going to say, things change rapidly. This has actually changed since this morning. When I looked at it a few hours ago, our 5 was solidly below the 20, and I was prepared to close this thing out. I was going to say, well, yep, we got a crossover telling us to get out on Monday. We didn't have webcast on Monday. So now we're looking at it here on Friday. What's going on right now as we speak? That 5 exponential is just about to cross up over that 20 triangular. And that might be giving us another bullish entry. And probably the last thing I want to do is exit right when the signal is to enter. So I'm going to back away from the original plan. I'm going to leave this one alone. But I do want to say, as I go through these indicators, if you're new here, and I see 200 people watching, I don't think that everybody saw this discussion. You can catch up, play a little game of catch up if you'd like. Just go to our YouTube channel. By the way, as we go there, make sure that you're subscribed. If you haven't subscribed yet, you can go right down in the lower right-hand corner, click on the little subscribe button. That only takes a second. It doesn't cost anything, but it subscribes you to our channel. But if you go to our channel's homepage, and the full name of our channel is Trader Talks Schwab Coaching Webcasts, you can find the playlists of our webcast series right here. Of course, you can also join the live trades, but make sure that you're subscribed. Then come check out these playlists. And let me just walk you back through history for the ones that we're going to be discussing today. We have a bunch of playlists. This one, I'm just going to scroll. If I pull my scroll bar about halfway down, there's our advanced charting techniques playlist. So I'm going to click on view full playlist. And then if I go down, it was a couple of months ago. This one was titled Example Chart System for Faster Signals in Faster Markets. We went to a shorter term time frame. So testing trade system reflexes was the thumbnail. This one will teach you about the 5 exponential and the 20 triangular moving average crossover system that we're using today. Another one for our other trade is going to be this one, where we use the parabolic stop and reverse to plan and place a trade. So you might want to check those out. And while we're here, we're also going to be looking at the S&P through the lens of what I call the trend value momentum strategy set. That you can find just a little bit further down. I think that was more like 5 months ago. So you might have to scroll down a little bit more. There it is, understanding the trend value momentum chart trading system. So lots of valuable stuff that can be found there if you use our channel on a regular basis. You're going to those. Anyway, let's go back here. And if we want to see the original trade, I might actually need to blow this out a little bit. Let's change our time frame here from just 20 days on an hourly basis. Let's go out. I don't think it was 90 days, quite that far, but that's okay. We'll go to 90 days back. There's the original entry and exit signal. So the entry signal was here as we're getting that bullish crossover. We got a bearish crossover, but I was actually out of the office and we weren't there to witness this. A trader who was trading this system better be paying attention. But that was the original plan for the trade, and then it's kind of taken off since then. I was just ready to wrap it up today, and then it's doing this to me. So we're going to leave that one alone. All right, but let's go on to our next one, which is our AT&T trade, where we own 200 shares. They're doing okay. We go to that chart of AT&T. This one was on a different time frame, so I need to switch this one back to our 1-year chart. We can do that right up here at the top. You can change the time frame right there. And I saved the set of studies for this one, different set of studies. I'm going to go up to our studies, and instead of saving a new study set, let's load up our AT&T parabolic stop and reverse and the 100 simple moving average study set. Now with this one, if you're not familiar with parabolic stop and reverse, basically consists of a series of dots, which is going to kind of be a theme today. And what we noted here was that we had an upward sloping moving average indicating an extended persistent bullish condition for AT&T. And within that, we had a bullish signal here as our dots, our PSAR dots, shifted lower and started to rise. And a typical approach here is as those dots are rising, the trader might move their stop price to just maybe like 1% below the current dot. So our dots are still rising. We still have that bullish condition on our moving average. Let's move our stop up to 1% below that dot. And again, if you don't know what parabolic stop and reverse is, PSAR, that's okay. You now know where you can go find that in the library. Unfortunately, I can't cover every technical indicator under the sun in just one webcast, but logic here being we're just going to follow these dots up. As long as price remains above those dots, we're sticking with this trade. So what's the current dot position? You can actually just point at it and look right up here, and you'll see its value. See that number right there? So if I point at the last dot, it says the current value is $27.27. 1% below that would be just about exactly $27. So our original stop is right here. That's at $26.43. Let's push this up. We can click and drag that up to 27. And we get a pop-up here indicating that we are canceling and replacing that original stop. So we're going to move that up to $27. There's not a commission on this trade, but there can be on some types of trades. And with stop orders, there's no guarantee that the execution price will be equal to or near the activation price. In this case, that activation price being $27. But I'm going to send that off. There we go. Sia says, Cameron, do you have an exit set up on your Amgen trade? I don't, because the plan there is just wait for the crossover. Now, what I would like to do, now, obviously the trader at home would just be monitoring those, literally on an hour-by-hour basis. If someone is trading on an hour-by-hour basis, they got to be paying attention. Now, there are ways maybe with scripting we could automate to that to some extent, but yeah, it might be something we'd want to pay more attention to, set an alert. But in this webcast series, we'll just keep an eye on it. So when we see it, yes, in hindsight, probably, we'll talk about it and then we'll close it out. Okay. But there are two current positions. Let's see what's going on with the S&P 500. And with the S&P 500, let me go up to our study sets again. And I'm going to load up our study set of our TVM, Trend, Value, and Momentum strategy set. And so with this, we have an indicator for trend. We have an indicator for short-term, quote-unquote, value. Our price is high or low in the short term. And what's the momentum of price doing recently? That's what our MACD histogram is here to do. Again, if you want to see a deeper discussion than just that very brief introduction to this set of technical studies, go to the channel and look for my my previous webcast on the topic. Now, another thing you can do, let me show one other thing for those that are new, because we're up to about 230 people now. Not everybody's going to know exactly how to do this. If you go to our channel on YouTube, again, Trader Talk Schwab Coaching Webcasts, and let's say you have an interest in, hey, Cameron mentioned this TVM thing. Where's a webcast on TVM? Just do a search, TVM, and enter. Hey, there it is. Understanding the Trend, Value, Momentum Chart Trading System. So this little search box can be pretty powerful. All right, but what's going on with trend? Well, in this case, our 50 triangular moving average has just closed up above the 100 triangular moving average. And a triangular moving average is basically a double smooth, it's kind of sounding. It's a smoother moving average than some of the traditional moving averages. For some, that might produce a hopefully a higher quality signal, maybe not quite as many signals. But again, the objective there being an improvement in quality. It's not a guarantee, of course. But our 50 just crossed up above the 100. That would be typically interpreted as bullish. Okay, not bad for somebody with a pair of stock positions like us. Second thing, though, what's going on with our value indicator? With RSI, if we were looking to enter into a new trade, what we might be looking for is for RSI to get down to extreme lows, at least down below 40 in an upward trending condition. Well, it's not down below 40, but we don't always get the perfect confluence of indications every Friday when we meet. Right now, we have bullishness on trend. This is sort of neutral to somewhat bearish as it's working its way down. So is timing optimized according to a trader who might be using this in their approach? Probably not. Now, finally, what's going on with our momentum oscillator? With the MACD histogram, what the trader commonly is looking for, if they're looking to try to get in at what they see as the best moment, they might look for a deep dive on this histogram, going into deep red and then shifting to a shallower or a darker red. So like right here, we saw a shift from selling momentum, so maybe not so much selling momentum. And you can see that coincided with a pretty good bottom on the S&P. Is that where we are right now? Not really. We have gone a little bit deeper into red, but not greatly. But all we would need here, even if we got a slight uptick, that could be a confirmation that possibly finding a floor within this upward trend. So not a perfect confluence of technical indications using this combination of technical indicators, but it's not designed to be perfect every week. Some traders might just choose to wait for new positions if they use this sort of an approach. We don't have that luxury. I'm going to go ahead and plan and place a trade. But with that as our backdrop for the S&P 500 now, let's go introduce ourselves to this thing called the TTM squeeze. Now, some of you said that you were familiar with the TTM squeeze. Let's talk about how it's built. And Chris B, you called it out already, ruined my whole presentation. I'm just kidding, but we are going to be using BAC. All right, so let's come up here. Let's clean up our studies. I'm just going to remove all the studies that we have right now. Get a nice clean look at the chart of BAC, and I'm going to apply not the TTM squeeze, but actually one of the two studies that are used to create the TTM squeeze. So the TTM squeeze actually starts life as a Bollinger Band. So I'm going to come up here to our little study flask. I'm going to click on that. Let's add a Bollinger Band. So as I just hinted, the TTM squeeze actually springs from two other technical studies. So I'm going to explain what those two are and why they're sometimes used in combination to generate a fairly unique sort of a signal. Let's apply our Bollinger Band here. And if you're not familiar with Bollinger Bands, the way that it's constructed is we have a 20-period simple moving average. That's this green line. So it's intended to represent trend, potential support, and resistance. But typically, our Bollinger Band trader is looking for this to be moving upward. And then let's talk about these other two lines. These show essentially how volatile this stock is being. Is it being comparatively more volatile? Well, if it is, those upper and lower bands will widen. If it's being quieter, those bands will narrow. So those bands are set to standard deviations above and below our trend line. If you don't know what a standard deviation is, that's okay. I'm not going to go deeply into that, but if you're saying, Cameron, I don't know what a Bollinger Band is. That's okay. If everybody's somewhere along their own personal learning curve, if you have an interest in learning deeply about Bollinger Bands, guess what you can do? Come here, do a search for Bollinger Bands, Bollinger, and there are several videos right there. One that I might suggest, if you're new to it, Beginner's Guide to Trading Stocks with Bollinger Bands. And while you're here, as another spoiler alert, second spoiler alert of the day, maybe check out Keltner channels. Keltner channels. So we'll type in Keltner and hit enter on the keyboard here. And this is the second indicator that is combined with our Bollinger Bands to create our TTM squeeze. All right. Anyway, if you trade Bollinger Bands at all, you've heard of a Bollinger Band squeeze. Hey, that sounds familiar. The concept here being when we go from a period that's highly volatile with wide bands to a period that is quieter with narrower bands, that might be seen as sort of the calm before the storm. Maybe this stock is ready to pop in one direction or the other. With each of the indicators that we're talking about today, Bollinger Band, Keltner channels, and the TTM squeeze, they don't really give us an indication of direction, but they do give us signals, right? So the Bollinger Band doesn't know which way price is going to head until it heads that way. But it can have benefits beyond that. Anyway, so you'll see periods where we have this wide spread between the Bollinger Bands, and then they narrow together. And so these sorts of events, let's highlight some of those. We might call this a squeeze. You see that? Where the two bands are coming together. Notice I'm kind of whipping through here and just grabbing some that just hit my attention immediately. But this is where one of the failures of Bollinger Bands. Leanne says, what time frame are you on? So this is a 1 year daily chart. So the whole chart is 1 year. Each candlestick is a day, right? And that's just for example purposes. These indicators can be used on different time frames, hourly charts, weekly charts, whatever the trader's preference is. But we'll just be using the 1 year daily chart to illustrate things for this discussion. The problem with a Bollinger Band squeeze is that there are a lot of them, and they can lead to all sorts of signals of varying quality. Sometimes they work, sometimes they don't. Like right here, there's kind of a mini squeeze. What about, isn't this a squeeze right here? Isn't this a squeeze right here, followed by another squeeze right here? That's a problem for Bollinger Band traders. They're getting all of these false signals that aren't really leading anywhere. So this problem was recognized, and there's been an effort by some traders to address that through this indicator known as a TTM squeeze. So here's how it's constructed to filter out, hopefully, some of those false signals. I'm going to right click and just clear up all these drawings that we've made. And we're going to bring in our second indicator, and this is the Keltner channels. So I'm going to go up here to our Edit Studies icon. Let's type in Keltner for Keltner channels. Add that to our chart. And before I click apply, I'm going to make, this is just so that you can see it better. This isn't necessary. I'm going to make it a little bit thicker. Let's go with our upper band. How about we make that a 1? Let's go with a 3 out of 5 in thickness. The lower band, I'm going to make that a 3 out of 5 in thickness and click OK. Click apply. Anyway, but what that does is it just draws your attention to the two new lines that have been added to the chart. Keltner channels, if you're not familiar with those, by default, they start with exactly the same thing a Bollinger Band does. It starts with a 20-period simple moving average, and then it draws lines above and below those. Except instead of going 2 standard deviations above and 2 standard deviations below, it goes 1.5 ATRs above and 1.5 ATRs below. Now, if you're not familiar with ATRs, you notice, man, we're starting to stack. We're really layering indicators. Now, my apologies. Yeah, this webcast series is called Advanced Charting Techniques. Sometimes it gets a little bit deeper in the weeds, but an ATR just stands for Average True Range. Basically, in a nutshell, it just calculates how how much does this stock move in a typical day? Top to bottom, over a 24-hour period, what's the range in price on a stock for a day? Default is going to be over the last 14 days, so it gets an average for that. And then we take that average and multiply it by 1.5, and that's determining how far above and below our simple moving average line these lines are being drawn. Or another way to think about that is that if we were to draw a range for how far this stock would travel over a typical 3-day period, if it were going straight up or straight down, that's about the range that it would cover. That's that 3 days just being 1.5 days up or 1.5 days down. All right. Now this, to our frustrated Bollinger Band trader, is a really helpful tool, because what they might look for are periods when our standard deviation narrows so much, price quiets down so much that you could fit the standard deviations inside of just 3 days. That's the concept here. So when our Bollinger Band calms down, if it narrows, it's not just if it narrows, did it narrow sufficiently to get inside of our Keltner channels. So do you see, like back here in September, our Bollinger Band lines are narrowing from the top and the bottom, and now they fit inside of our Keltner channels. Even with 2 standard deviations over the course of 20 days, we could fit that range inside of an average 3-day period. That's a quiet period. That, to our trader, might say, hey, this squeeze is a little bit different than some others. So for example, here was a squeeze, it didn't get inside of that narrower range. Here was a squeeze, and it did. So when we burst outside of that narrower range, it might signal a stronger move that might be about to happen. So all of this, yeah, John says, will you see that real time? Yes, John, this is updated real time. So now that we understand the concept of the TTM squeeze, it's a pretty quick step to seeing it using our indicator. So let's come up here. Let's add our TTM squeeze indicator, add that to our chart, click apply, and click OK. And what you'll see with this indicator, it basically consists of a series of dots running through the middle of the indicator, and then it has these interesting histogram bars above or below the dots. So let's focus on the dots for just a moment. The dots signal whether the Bollinger Bands are inside the Keltner channels or outside the Keltner channels. In fairness, do we even need this indicator if we just want to look at the channels up here? No, it's just that this is visually much simpler to just look at dots. So green dot means the Bollinger Band is outside the Keltner. Red dot means the Bollinger Band is inside the Keltner. Now, there are going to be times where the Bollinger Band sneaks inside. Let's zoom in. Let me zoom in right back here. There are going to be times where our Bollinger Band comes down, sneaks inside that Keltner channel, and pops right back out. It's kind of hard to see, but our Bollinger Band went right back outside of our Keltner channel. So there was only one red dot, meaning that we squeezed, but it was very temporary. It was like a rapidly passing storm. It's just a squall. Who cares? Might be the interpretation for some traders. It's when we get an extended period where the Bollinger Bands have quieted down, they're sitting inside that Keltner channel for an extended period of time. That's when our TTM squeeze traders might get a little bit excited. So if the concept of this series of red dots means that we're going through an unusually quiet period, how long? What very commonly happens? What's been your experience? When a stock gets really calm, what seems to be likely to happen after that? Could it be the calm before the storm? Yeah, that's what a TTM squeeze trader interprets this to mean. When we get a single red dot, okay. 2 red dots, 3 red dots, 4 red dots. Actually, the typical minimum is if we have 5 red dots, meaning that we've had our Bollinger Band sitting inside of the Keltner channels for at least a week, that's a pretty long quiet period for the stock. And what some traders might see that as being is this is the calm before the storm. Maybe there's a big move coming up that could go up, it could go down. It could also be interpreted as sort of the coiling of a spring. It's just getting tighter and tighter and tighter. And then boom, right, Paul? Yeah. Yeah. Now, Sabrina says, Sabrina, let me get in your head for just a moment. Let me guess. If this is your first time ever being introduced to this technical indicator, it can seem like some pretty heavy lifting to really understanding how it's built, right? True. However, understanding how it's used, in my view, not nearly so difficult. So if you feel like, it's been intimidating to understand the indicator in like how it's constructed, let that go, because understanding how it can generate buy and sell signals, I think you're going to be able to follow just fine. Okay. So yeah, if we get a single red dot, okay, things got quiet for a moment, nothing to get excited about. A typical TTM squeeze trader is looking more for something like this. Do you see this right back here? Starting at the end of January, maybe the 1st of February. You'll see we get a red dot, and another one, another one, another one, another one, another one. When we see at least 5, and I'm going to zoom in here. Let's zoom in on those 5. 1, 2, 3, 4, 5. Now the trader's on high alert. Hey, this is a longer quiet period. This stock is in the middle. We're in the eye of the storm, and this stock may pop up or down. That's the way they interpret it. Is it guaranteed it's going to go that way? No. But here's a typical practice. Now that we're starting to identify how this might be used, let's start planning a trade. Okay. First thing is to look for red dots. Second thing is when we get the 5th red dot in a row, we'll look up at the price and identify where have the highs been recently and where have the lows been recently, and we're going to draw a line for those. So here's our 5th red dot right here. I'm going to go up to that time frame, and let's look back in recent history. It looks like the highs were up here and the lows were down here. So that defines for us the channel that led to this quiet period. Remember, the dots actually need about 20 trailing, they actually need 20 trailing days just to be calculated. All right. So I'm looking back about that time frame, maybe over the last 4 weeks or so, and looking at where are the highs and the lows. There's our quiet period. And for the trader from here, what are they looking for? Well, they're looking for a break from that. This is sort of the new norm. We need to see, has the storm started again? Now, what we don't know, and what these dots don't tell us, just because we shift back to green, it doesn't tell us whether price is moving up or down. The red and green dots do not mean up or down. All they mean is inside or outside the Keltner channels. Now, what can indicate price direction are the histogram bars. If we get to the end of our red dot period and we get our first green, that might signal that the stock is on the move. And then the color of the histogram bar might tell us which way that stock is likely to head. So I'm going to right click here. Let's activate this drawing that we just made and extend it out here to our first green. So now we've identified our channel, our trading range, and we have a signal that, hey, that range has ended and maybe price is set to go in a new direction. In this case, it's a red histogram bar, so the trader might plan a bearish trade on that signal. If we get a green histogram bar, and if we're pushing up above these recent highs, that may signal a new bullish trade. So this can signal in either direction, right? So yeah, if you got lost in the weeds, okay, so we start with an ATR and a Bollinger Band and a Keltner channel, and then we combine those all together. Somehow it generates this TTM squeeze. Don't worry about that. Instead, can we look for red dots? Can we identify green dots? Can we see which way the histogram bars are moving on the appearance of the first green following 5 reds at least? Okay, now we're a TTM squeeze trader. All right. So yeah, this is a bearish signal. So that's an entry signal for a bearish trader. What might be an exit? And this is going to be an example of what I would consider to be a failed trade. Although ultimately it worked out, but I would suspect that the traders who took this signal didn't exit profitably. But here's a typical trade management technique for planning the back end of the trade, for taking profits or taking losses on our bearish signal. Well, on bullish or bearish, what the trader commonly does is they look at the distance between the highs and the lows. And if we're moving in a new direction, they might expect a move of that same magnitude in that new direction. So in other words, here's a quick technique we can use on Thinkorswim platform. Right-click on our channel that we've drawn, and let's duplicate that drawing that we've made. What that allows me to do is click and drag, and I have this new drawing, and I can just take it down here and sort of position it, intersect it with the original, and it gives a projected target to the downside. So a bearish trader who saw this signal might be looking to get out if it goes down an equal distance to its previous trading range. So in this case, looks like our low was down around about 405, the high 45. The high was up here around 48, so about a $3 trading range. And we broke out of that range. Well, maybe if we were trading in a $3 range before, we might go down another $3, down to about 42. And guess what? It did in this case. Unfortunately, Art says, what would be the exit? What would be the risk management exit, right? Art, if this is the fun part, where would we take profits? Oh yeah, what's the other side of that coin? Where might we take losses? Well, a common risk management technique is once the stock starts to move, the assumption is we should make our way down toward our target in the case of a bearish trade. If the stock starts to strengthen and it goes back up inside the original trading range, there's typically not much patience for that kind of nonsense, and the trader may just cut the trade off. So guess what? In this case, I think there was a little whipsaw here that caused these traders to exit unprofitably, and then it went down and cooperated. Does that happen sometimes? Yep. There are other examples on this chart. Let's see. Back here, let's zoom in on this time frame. Here we got red dots, 1, 2, 3, 4, 5. Actually, I might not have zoomed in, or I might have zoomed in a little bit too closely. I'm going to zoom back out. Let's grab some more information here. I might have to go back even further because our highs stretched back further. There we go. So there are 5 dots. It happened on this day. If we look back over the trailing 4 weeks or so, where were the highs and where were the lows? Let's draw those in. The highs are going to be up here somewhere. There we go. Lows are going to be down here. So there's our trading range. And we started to get greens. We got a green and a red. That's okay. Only one red. It's a blip, something we don't really care about. Another green, but we were still inside. Price hadn't been decisive enough. Our histogram is starting to say, Cameron, we're getting bullish, but not yet. There we got price outside of our range. We're looking at green. We're looking at bullish histogram. There's an entry signal. Okay, so take what we just learned about bearish trades and just invert it for bullishness. Well, if we use the depth of the original channel to gauge a price target for a bearish trade, guess what? Same logic. So here it looks like we were trading from about 38 up to about 41. That's, again, a $3 range. Doesn't always work out to be $3, just did in these 2 examples. Where might a target be for a bullish trader? Well, 41 plus $3 would be up here at 44. Where might the trader exit if the trade fails? Well, if we slip back down inside that range. So if we get back down below 41 to any extent, it might only be a few pennies. Some traders might allow it. It depends on the depth of this pattern. With $3 as the maximum that we could possibly make, if our timing is awesome, do we want to take a $2 risk? Probably not. Maybe the trader only gives it a quarter. 50 cents inside that channel. But those are our examples here. Now, interestingly, and this is what Chris B called out, what do we have right now? Oh, look at Chris. It actually wandered back on us. And someone asked, who asked, does this update in real time? This used to be a green dot. It's a red dot right now. So our traders might hit the pause button. I'm not going to. I'm going to say, guess what? Let's just imagine it's green, just in the interest of time. But if this is your first time being introduced to this kind of a trade system, maybe go to Paper Money and load up some stocks. This is actually something that's really quick to check to see whether we have recent reds or not. Once you have TTM squeeze here, and you don't even need Bollinger Bands or Keltner channels on here, right? They were just there to explain how this thing is constructed. We just need this down here. Well, from here, we could just bring up, let's say, the S&P 100 or 500 or whatever kinds of stocks the trader prefers to trade, maybe look at their own personal watch list, and just go through those. Oh, that's a series of greens. It's not a signal yet. NVIDIA, nope, still green. Apple, oh, what's this? Oh, that one's winding up. Let's see if we get a signal later. And so on. It literally only takes a glance to see if there's an entry signal or there's not. And it might take 30 seconds or a minute to find one. All right. But for this one, back to BAC. As Chris noted earlier in this trading session, that was green. This thing has snuck back down below. So it's gone back down to red. Or in other words, our Bollinger Bands popped outside the Keltner channels for just a moment earlier today. Now they've gone back inside, even without looking at them. I know that's what's going on because we understand the indicator. Guys, forgive me. Let's just say we think this is green. The trader might want to wait till the end of the day to see if it stays green. But let's just imagine this is green. Let's plan and place a trade. Where would our target and stop be placed? Well, it looks like our recent resistance is up here. Support was down here. Looks like, again, shade over $3 range. If we're breaking out at 45.5, where might that be a target? Maybe up at 48.5, right? Looks like we're buying at 45.5. Let's look for a target of 48.5. If we get back down inside that range, unfortunately, we're still in there right now. This was looking a little bit more promising an hour ago, but let's give this not much more wiggle room. Let's say if it slips down here, let's call it 44.75. It's going in the wrong direction. It's back inside that channel. Then the trader might get out. So just remember those two prices, 48.50 and 44.75. Then we can go place our trade. Go to our trade tab, right-click on our ask price, put in a custom buy order with an OCO bracket, calculate how many shares we want. For this one, let's go ahead and let's link them together and do 100 shares. I'm going to put this in as a market order. Obviously, there are risks when we enter an order at the market. Let's put our target up there at 48.5. Let's put our stop down there at 40. What was it going to be? 43.75, 44.75. Go. Make those both good till canceled, and we have planned a complete trade idea with just that one indicator. Let's click confirm and send. We're going to buy at the market price with market orders. Prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. And with stop orders, there's no guarantee the execution price will be equal to or near the activation price. Let's send that order off, and we're going to see. We're going to see if the stock continues working its way higher, but there's your introduction to the TTM squeeze. Guys, we've accomplished what we set out to do today. And this is what we do in this webcast series. So if you're interested in learning about charting, make sure that you're joining me on Fridays, 1 Eastern, or just watch the archives. That's fabulous. But to assist with that effort, make sure that you're optimizing your other resources from Schwab Education, starting with subscribe to the channel. Right down in that lower right-hand corner, you can click on the subscribe button. It only takes a second. It doesn't cost anything. but we house our previous webcasts on our Trader Talks Schwab Coaching webcast channel. That's where you can find our playlists. You can also do searches for topics of specific interest on our channel right here, just as we did earlier. And you can join our live streams. Also, make sure that you're following us on X. You should be connecting with your favorite presenters on X. You can find Ben there on X at Ben Watson CS. You can find me at Cameron May CS. Make sure that you are being precise with these handles. There's my handle at Cameron May CS. Great place to connect. Like, you can even give me your feedback on like things like this I just posted a couple of hours ago. Hey, Chartist, do you think we're going to be getting this golden cross on the NASDAQ? What might that mean? So great resource there. Ben, thanks for helping out. Everybody, go enjoy the rest of the day. Enjoy the rest of our webcast. I don't believe, Ben, there wasn't a, oh, there is a survey. Yeah, there was a survey. So if you do me this favor, click on that survey link now and just give me some feedback. It's only 2 multiple choice questions, a comments box and a suggestion box. I will read through your comments. It always helps. All right, everybody. Thanks for giving me your time today. Give us a thumbs up if you enjoyed the webcast. That always helps. I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.